The yield curve is the shape of interest rates for deposit products. So when you think about interest rates, you would expect to earn a higher rate of interest on a long-term deposit than you would on a short-term deposit. What an inverted yield curve is when the front end, the short-term deposit, is higher than the long-term deposit. The reason you care about that is that curve shape, when it inverts, is predictive of a recession. On average, it takes about 40 months before a recession shows up. But yet, in that period of time, during those 40 months, the average stock market return is 67%. So it's actually a really good time to be investing. From an individual standpoint, the bond market instantly reacts, and the prices of the bonds tend to decrease whenever interest rate expectations of change show up in the markets. So what you need to do is to understand how to allocate risk across your 457B, 401k, and split dollar plan, not based on your expectations for interest rate risk, because the truth is you don't know exactly when that risk is going to show up. You want to do it based on your understanding of the time until you're going to spend that money. You want to make sure you understand what rate of return you need to earn on those assets and how long you have before you're going to consume those assets. What I would suggest you do is to make sure you understand where to allocate risk in your various asset categories. Perhaps the most important thing for you to understand when you're dealing with market turmoil is your individual index. By that I mean your personal rate of return that you need in order to make your financial plan work. If you know you need a 3.5% rate of return, and you're going to spend your 457B 10 years before you spend the 401k, you know to take your risk in the 401k plan and leave your 457B in cash-like instruments that are safer for immediate spending. When you have the personal index in mind, you can use it to compare how are you doing this year, not versus the S&P or your neighbor, but versus your individual index, so that you can tell, are you staying on track for your personal goals given the economics of today and the risk that you're taking across those plans. If you're concerned about the potential for the inverted yield curve to possibly predict the next recession and how it's going to impact you, let's talk. Once you have your personal index and the right allocation of risk across your plans, you'll be in the best position to get through whatever the future has in store.